Good morning. Welcome to Stock Market Today. It is Tuesday, December 22nd, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I am at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. So U.S. equities were mostly lower on Monday, though the major indexes finished near their best levels after reversing the morning's weakness. Fins and technology led and were the only sectors higher on the day. Energy, utilities, and staples were the biggest laggards. Treasuries were mostly stronger with the curve flattening. Dollar was better against the euro, little changed against the yen. Gold finished down 30 basis points. WTI crude settled down 2.6% after gaining for a seventh straight week last week. And as we get to the desk this morning, S&P futures are slightly higher, about 25, 27 basis points the last time I looked a couple of minutes ago after Asian markets were under pressure overnight. European markets are seeing good gains. Treasuries are stronger, the curve flattening. Dollar is stronger on the major crosses. Gold is down 10 basis points. WTI crude is down 1.2% to kick us off on a Tuesday morning. That starts out after the stocks across the board closed well off their lows of the day. A little bit of a consolidation here above the breakout levels is the best way to describe the S&P 500 as well as the Qs. IWM continues to be a little more extended from the breakout level. It has been leadership, and that remains the case. So really not a lot has changed in our view from day to day. S&P 500 has near-term support, or the SPY has near-term support at 360, 340 being the key level to watch below that. Between 340 and 320, things get a little more choppy. And then below 320, we have to consider the trend having reversed. For Qs, 260 is key. 300 is important in the near term. That's the breakout level where we can say that this is not a false breakout as long as we're holding above that 300 mark. For IWM, support near 170, then 160 below that. And I really don't think it would be the most unhealthy thing on earth if we saw some consolidation in the 180, 190 range for IWM to set the stage for a continuation of the advance as the new year begins. For SPY, we continue with the view that above 340, there's potential upside to 413. A lot of headlines back and forth, but at the end of the day, it's the message of the market that makes the most sense. So we continue to lay out the important levels as we see them to provide a roadmap to kind of help guide the way, if you will. Obviously, the headlines are important to keep an eye on, but more important is the market's reaction to them. Obviously, COVID's still an issue. We did get the stimulus bill that's long been anticipated. I think it's fair to say that a lot of that good news is priced into the market right now. However, bigger picture, the trend remains as it has been, so we shall stick with it. Let's hit our market in a minute now. What are we writing about in the note today? Well, it's Tuesday, so we're doing our sector work. And, stocks finished well off the lows of the days. Of the day, we were down hard in the morning and then rallied back throughout the day. So that was an encouraging sign for the bulls. Tech breaks the recent relative downtrend. We'll take a look at that. Remember, technology has been a source of funds for over 3 months, at least on a relative basis. Perhaps it is beginning to reemerge as leadership, and that is playing out as the defensive sectors continue to lag the broader market. Areas like REITs, utilities, and staples are trading on their lows. So that's an interesting dynamic that we want to continue to focus on. In my note, we screened for mid and large cap relative strength. We'll talk about that in just a moment. And as I said, futures do point to a slightly higher open here today. Let's dive into the power bars now for the major indices. The Dow did actually finish higher yesterday, up 3 basis points, 4-2 bulls to bears there. S&P 500 down 41 bips, 127-54 bulls to bears. NASDAQ was an outperformer, 18-8 bulls to bears. And small caps were also an outperformer, i.e. being down less than the S&P 500, 823-123 bulls to bears. Bonds upticked, sending yields lower. Financials were your standout at the sector level after the Fed gave banks the okay to resume buybacks. And when we take a look at the leaderboard a little bit later on, you'll see that reflected. Financials are a group that we've been warming to over the past couple of months. In particular, the banks So this is a nice positive data point to go along with that trend. Let's dive into the screen of the day now. What I wanted to do is just kind of screen for relative strength. I'm of the view that we could see some choppiness, some consolidation here in the near term. That's within the context of a bigger picture trend. So what I like to do in that environment is identify the relative strength. So I use the Russell 3000 as a starting universe, and I just kind of narrowed it down to mid and large cap names within that group. And I signaled out the names that have a very bullish Chaikin power gauge rating. And then under our factors, I wanted the technicals to be bullish. And then beyond that, getting a little more granular, stocks that are above their rising long-term trend line with strong money flow and strong relative strength. So a lot of the factors that we look for when looking for bullish ideas. And that screen returned 32 names that I think can be added to a watch list for opportunities should we get to an oversold level on the SPY and some of the other major averages, and that holds above, and they hold above key support. Well, then I think it makes sense to revisit a list like this and look for opportunities. You can see some of the higher profile names on here: CBRE, CNA, JCOM, Interactive Brokers, Regions Financial, Raymond James Financial. Seen a lot of financials on this list, which is interesting in light of the news. Oshkosh in the industrial space, Kohl's, right? The retailers have been hot. So a nice kind of mix of names here to potentially look at for ideas holding up on a relative basis. Should they continue to hold up if the market turns choppy? You're going to look for these names when the market stabilizes above support and is oversold. So an interesting screen that I'm running through today in my note for clients, as well as here for you all on the show. Let's take a look at our sector tracker now, the movement of the last 5 days. It's a good looking board. Considering tech as the largest weight in the S&P 500 is back at the top of the list, that's something the bulls want to see. And we'll touch on tech relative a little bit later on. Materials been a group that we've liked within the cyclical plays. We've touched on the financials a few times over the past few weeks to a month. Discretionary, kind of ho-hum from a trend perspective on a relative basis. Remember, discretionary is heavily weighted to Amazon, which remains in a consolidation. Healthcare and industrials round out the sectors that are higher over the past 5 days. Comms tried to get going. I touch on this in my note. They tried to get going on a relative basis, but have subsequently faded. Staples, REITs, and utilities are your defensive groups. So if you're a bull, you like to see those underperforming. Energy under a little bit of pressure after a near-term rally. We'd like to see that stabilize. The trend, bigger picture, has run into a bit of resistance at a declining 200-day moving average on a relative basis. That's in my note today. However, we are looking for signs of stabilization within the energy sector. Taking a look at our industry in focus now, speaking of tech, I think one of the biggest bright spots within the tech sector has been software and services. You can see over the past 6 months, it's been an outperformer, leading the S&P by about 19%. 48 to 10 bulls to bears gives it a very strong power bar ratio, and it's currently ranked number 12 of 21 subsectors. It's moved up 3 slots over the past week. There's JCOM with a very bullish rating. Go back to our work here on the screen. There's JCOM. Kashi, CACI, and Science Applications, SAIC, also have very bullish ratings. All three are holdings of a fund that looks like this. I mean, up and to the right, you can't argue with it. So while tech has been in a consolidation and maybe just emerging on a relative basis, the software and service group continues to eat the world, as the saying goes. Bullish ETF rating for XSW, which tacked on 11 basis points yesterday. Strong trend above the rising long-term trend line. I guess the only thing you can say here in the near term is maybe it's a little bit of extended. You like to see a bit of a consolidation, but we have a bullish fund that is outperforming the market with bullish money flow, right? Here's your extension above the upper volatility band and overbought here in the near term. However, when I'm thinking about relative strength, I have to think about software. I want to drill down on the XSW or some of the other software ETFs if I'm looking for individual names when the opportunities present themselves. So take a look at XSW as you're doing your work here. Yesterday's movers and shakers are gainers and losers. You can see the leaderboard with the exception of Nike, which was up following their earnings announcement. The rest are some of the financials and banks that have and made announcements that they shall resume their buybacks. Goldman Sachs going to resume their buyback in the first quarter. That stock up 6%. Morgan Stanley announcing a $10 billion buyback. That stock up 5.7%. Cap One, the stress test results unveiled the capacity to resume their dividend. So not quite a buyback, but similar train of thought there. And JP Morgan announced a $30 billion buyback to send that stock higher by 3.75% on the day. Loser side of the board, a little bit more of a mixed bag. Oxy upside, a tender offer for some bonds, upsized rather, the tender offer for some bonds. That stock went lower by 5.7%. SL Green, REITs under pressure with the news over the weekend of a new COVID strain out of the UK. CNC following through on some guidance on Friday, stock weak for a second day. VTR, nothing company specific, but a senior living facility as we're getting new COVID news. That stock down nearly 4%. And I didn't see anything company specific to drive that stock lower by 3.88% on the day. So let's take a look at it now. This is what jumped out at me in my sector work today. XLK reemerging. So here's XLK relative to the SPY. Remember, this is a relative chart that we're looking at. When the line is rising, that means tech is outperforming. When the line is falling, that means tech is underperforming. We've seen some underperformance since those late August, early September highs. Consolidation here that did not break the rising 200-day moving average and has now regained the 50-day moving average while breaking this downtrend line. All the while, important to remember that during the consolidation, the ratio never became oversold from an RSI perspective. And now the RSI is beginning to work higher and regain bullish ranges. Now, on an absolute basis, tech is knocking on the door of a breakout at those early September highs. Not quite out yet. Kind of looks like what the NASDAQ looked like a couple of weeks ago as it was struggling to break through 300 and then finally did. Is it the same story for tech? I don't know, but it seems to be pointing in that right direction. And what does that mean for the broader market when your largest weight, which has been a drag, is now beginning to get back in gear? Remember, the S&P 500 continued to work higher as tech was underperforming. So now what happens if tech gets back in gear? Right? Does it come at the expense of some of those other areas? Do we see breadth start to narrow again? So far, no signs of that. We'll do our breadth work tomorrow. But tech reemerging as leadership has to be considered, in my mind, a bullish data point for the overall market here in the near term, something we're going to continue to watch very, very closely. At the same time, right, we don't want to take any one data point in isolation. We want to connect the dots. So if you want to maintain that bullish view on the market, tech getting in gear is obviously important. But I would argue that equally important is the fact that these defensive areas of the market continue to underperform. All three of these charts are of the defensive sectors relative to the SPY. So at the top, we're looking at utilities knocking on the door of the September lows below a declining 200-day moving average. Looking at real estate, XLRE relative, trading down near 2-year lows below a declining 200-day moving average, and take a look at the staples as well, trading near at or near 2-year lows below a declining 200-day moving average. So you have tech reemerging as leadership potentially, while your defensive groups are underperforming. I would say that that is a bullish dynamic for the market in general, at least as I connect the dots. And obviously that's what we do all week, right? In my note, we are connecting the dots and trying to frame up the path of least resistance and what the odds are dictating for the broader market. And right now, notwithstanding the potential for overly bullish sentiment to lead some near-term choppiness, the facts remain that the uptrend is healthy. And within healthcare has actually been a choppy group with a downside bias, but biotech has been a solid standout there. Take a look at XBI above the 50 and 200 day. Overbought here in the near term based on the RSI. Using the scooter as a reference for relative strength, you can see a 96 for the score there. So a solid outperformer in biotech. So something to keep an eye on. If you're just looking at healthcare kind of looks weak, but drilling down on the industries, you can find some gems like biotech. That'll wrap us. Take us for a test drive. I'm back tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.